For years, Japan exported more than cars and electronics. It exported capital, borrowed cheaply in yen, leveraged across the world. The yen carry trade became a quiet engine of global finance. Hedge funds used it. Pension funds lived on it. Entire markets leaned on it. But what happens when Japan's interest rates finally rise and the carry begins to unwind? A trade that worked until the math changed. Start the machine.
There's this quiet, almost invisible financial engine that's been humming along for decades, really powering how capital moves around the world. And it's been fueled by something incredibly cheap, something, well, most of the world hasn't had easy access to for a very long time, the Japanese yen.
For years, Japan's interest rates were near zero, sometimes even negative.
Yeah, it wasn't just some weird economic quirk over there in Japan. It actually became like a fundamental piece of the global financial system, a structural thing people depended on.
Investors everywhere figured out ways to borrow that super cheap yen.
And pour it into markets, offering higher returns.
It built this massive interconnected structure. We call it the yen carry trade.
This is all about understanding this phenomenon. How does it actually work? Why are the recent and maybe future changes in Japan's interest rate policy suddenly making people nervous?
And who and what assets around the world are most exposed if this huge financial structure starts to, rapidly unwind?
We've got a stack of sources here, articles, research, data to help us connect the dots. Think of this as our mission. Understand the machine, see the threat, and map the exposure. It's a big story, potentially a liquidity earthquake triggered by subtle shifts in Tokyo.
Let's start with the basics then. Chapter 1. Cheap yen, expensive risk. Understanding the carry trade machine.
So the core idea, it's pretty straightforward on the surface, isn't it?
It really is. You borrow in a currency with low interest rates, the Japanese yen being the classic example, the main funding currency for ages.
Why the yen specifically?
Well, Japan's long struggle with deflation and economic stagnation meant the Bank of Japan, the BOJ, kept its policy rates incredibly low. Think near zero or even negative.
Our sources show that, like the BOJ policy rate was 0.00% way back in 2001.
Then it went negative. Now it went 0.10% in 2016.
And it only just started nudging up recently, 0.10% in March 2024.
0.25% in July 2024. So for over a decade leading up to 2023, it was this incredibly consistent, super cheap source of funding.
This is step one, borrow cheap yen. Step two,
convert it. Change that yen into other currencies, US dollars, maybe Australian dollars, British pounds, or even emerging market currencies like the Brazilian real or the Turkish lira, where interest rates were much higher.
Got it. And then you take those dollars or pounds or whatever and you buy stuff that pays you more interest than you're paying on that original yen loan, right?
It could be government bonds, could be corporate debt, maybe even stocks in those foreign markets.
And the difference in rates could be pretty stark. Our sources mention, JPY rates near zero versus US dollar rates hitting, 5.5% at their peak in 2023.
Or Brazilian real rates, often way above 10%. That difference, that spread, that's the simple goal. That's the carry.
So the profit comes from that interest rate difference, the carry. Simple enough.
Well, that's the core profit, yes. But it's not just about the interest rates. Exchange rates play a huge role.
This is where it gets more complicated
Oh.
and maybe dangerous.
Definitely more complicated and potentially much more dangerous. While that interest differential is why you do the trade in the first place, if the exchange rate moves in your favor, meaning the yen weakens, it actually juices your profits.
How does that work?
Think about it. You borrowed yen, changed it to dollars, bought US bonds, paying you interest in dollars. If the yen gets weaker against the dollar, when you eventually sell those bonds and convert your dollar earnings or the principal back into yen,
You get more yen back.
and the yen loan you took out initially also becomes cheaper to repay in dollar terms. So a weakening yen is a bonus.
But there's always a but.
The big but. The flip side. Exchange rate volatility is the killer here, specifically the yen strengthening. One of our sources calls it, quite bluntly, the primary nemesis of the carry trade.
Because it can wipe out your profits.
Wipe them out fast. Yen appreciation can erase months, even years, of those steady interest rate gains in a matter of days, sometimes hours.
Wow. And we've seen examples of this.
Oh yeah. The sources point out that even a modest 3% yen appreciation back in 2023 significantly cut into carry trade gains.
And then there was that move in August 2024.
When the yen surged over 10%, that caused serious problems, especially for traders using leverage. The quote we have is stark. Exchange rate risk is the biggest risk in carry trading as it can drastically overtake profits.
So exchange rates are critical. And you mentioned leverage. That sounds like pouring gasoline on the fire.
It is,
Yeah.
because those interest rate differentials, while attractive, aren't always huge on their own. So to really boost the returns, traders use leverage. Often, a lot of leverage.
Meaning they borrow even more.
Essentially, yes.
Yeah.
Forex platforms allow you to control a large position with only a small amount of your own capital as margin.
The sources give an example, like $100,000 versus yen position might only need $5,000 of your own money.
That's 20 to 1 leverage. And if the trade is working, maybe you're making, say, $17 a night in carry profit on that $100 K position. On your initial $5,000, that looks like an amazing return, doesn't it? Roughly $6,200 a year on a $5 K investment, if nothing goes wrong.
If nothing goes wrong.
That's the giant caveat. That calculation only works if the exchange rate behaves, stays stable, or, ideally, the yen weakens.
Because leverage cuts both ways.
Unforgivingly. While it magnifies gains, it dramatically amplifies losses. If the yen strengthens just a little bit against you, that small move gets multiplied by 20 in our example.
And suddenly your $5,000 margin could be wiped out?
Easily. Those nice daily profit numbers are completely meaningless if an adverse currency move hits you. Your actual outcome is that interest spread times the leverage, times how the exchange rate behaves. The FX move is often the most powerful multiplier.
There's that vivid analogy in the sources, borrowing snow to buy fire.
Yeah, I like that one. You're borrowing cold, cheap yen to the snow to invest in hot, high-yielding markets, the fire. Profitable until the seasons change, until conditions shift. And that snow either melts away your profits or it turns into an avalanche of losses.
So why did this strategy last for so long? Why did it become such a big deal?
Well, it was kind of a perfect storm, a symbiotic relationship. On one side, you had Japan battling deflation, which meant the BOCHE had to keep rates incredibly low, creating this constant supply of cheap funding.
And on the other side?
On the other side, especially after the 2008 global financial crisis, when rates everywhere else also plunged, investors globally were desperate for returns. This search for yield was a huge theme.
So the yen carry trade was the bridge.
It connected Japan's cheap money pool with the global demand for higher returns. One source puts it nicely. The yen carry trade has often served as a barometer of these global financial conditions and investor appetite for risk. It showed just how hungry the world was for yield.
Pause for a second. A quick micro recap of what we've learned about this carry trade machine.
We've seen the basic mechanic, borrow cheap Japanese yen.
Invest it in assets in other currencies that pay higher interest.
Aiming to capture that interest rate difference, the carry.
And we know profits are driven by that interest difference, but also, importantly, by favorable exchange rates, meaning the yen getting weaker.
But the biggest risk, the real Achilles heel, is the opposite happening. The Japanese yen appreciating, strengthening.
Especially because leverage is often used, which magnifies both the potential gains and those potential losses from currency moves.
And this isn't some niche strategy. It's been a major feature of global finance for decades, connecting Japan's unique situation with global investment flows.
Good. Before we move to the next chapter, let's lock in those core ideas with our flashcard facts.
Sounds good. Flashcard fact 1. Yen carry trade. Borrow cheap JPY, invest in assets in higher yielding foreign currencies.
Flashcard fact 2. Profit drivers, interest rate differential carry, and favorable exchange rate movements, JPY depreciation.
Flashcard fact 3. Biggest risk.
Japanese yen appreciation, magnified by leverage. And flashcard fact 4. Leverage, magnifies both profits and losses.
All right. So we know how the machine is built. Now, chapter 2. When the rates rise. How could Japan's policy shift actually shock the world?
Because the ground is shifting in Japan, isn't it? That era of ultra-low rates seems to be ending, or at least changing.
It certainly looks that way. Under the current BOCHE governor, Ueda, they're definitely signaling a move towards normalization. We've seen those small but symbolically huge rate hikes.
Ending negative rates in March 2024, moving to 0.10%.
Then another small step up to 0.25% in July 2024.
And the market seems to expect more, maybe 0.50% by early 2025.
That's the projection, yeah. Our sources quote people saying these moves could mark the end of Japan's boldest easy money experiment. And significantly, they're already igniting fears of capital flight money, potentially leaving overseas markets and headed back to Japan.
You can see it in their bond market too. JGB yields, Japanese government bond yields are climbing.
They really are. That 40-year JGB yield hitting 3.689% in May 2025, an all-time high. The 30-year yield is near 3%. the 20-year above 2.5%.
What does that tell us?
It tells us the market is anticipating higher borrowing costs for the Japanese government itself and likely further policy tightening from the BOJ down the road. The era of rock-bottom yields seems over.
And these rising rates in Japan, this is the core threat to the carry trade, isn't it? The potential trigger for the unwind.
As Japan signals tighter policy, or as JGB yields just naturally rise, those two key conditions that made the carry trade work start to break down.
How so?
Well, first, higher rates in Japan tend to make the yen strengthen because holding yen becomes relatively more attractive.
Yeah.
That hits the exchange rate part of the trade. And second, as Japanese rates rise, that interest rate difference, the carry you're trying to capture, starts to shrink. The whole point of the trade gets eroded.
So what happens then? What does an unwind actually look like?
It can look like a stampede for the exit. Investors who hold these carry trade positions all rush to close them out at the same time.
Meaning they have to buy back yen?
Yes, they need yen to repay the loans they originally took out. So massive demand to buy yen pushes its price up even faster.
And where do they get the money to buy the yen?
They have to sell the foreign assets they bought with the borrowed yen, those US bonds, Australian stocks, emerging market debt, whatever it was.
So they're dumping those assets, driving their prices down.
Precisely. It becomes this dangerous self-reinforcing cycle. Stronger yen forces selling forces yen stronger, asset prices fall. And it can happen incredibly fast, almost violently.
And we saw a taste of this in mid-2024.
We really did. Even just a hint of a slightly more hawkish tone from the BOJ, combined with some signs of slowing U.S. growth, was enough to trigger a rapid, if short-lived, unwind.
What happened?
Sources describe the yen skyrocketing. It jolted everything. U.S. treasuries, the Aussie dollar. In late July 2024, the yen jumped about 2.4% in just 1 week. And at the same time, currencies that are often targets for carry trades, like the Australian dollar and the Mexican peso, they sank 2-3%. Even other funding currencies, like the Swiss franc, strengthened along with the yen.
Bloomberg said it sowed havoc.
Yeah, their reporting noted the sudden yen spike sowed havoc as traders dumped assets to repay loans, leading to that brief but pretty dramatic global sell-off. It showed how sensitive markets are to this unwind risk. It's not just theory.
Let's dig into how the stress spreads. What are the dominoes, the transmission mechanisms?
First, there's the straightforward impact of rising funding costs. If Japanese interest rates or JGB yields go up, borrowing yen simply becomes more expensive for everyone, everywhere.
Banks, hedge funds.
Right. Anyone who relied on those cheap yen loans or currency swaps faces higher expenses. That squeezes their profits, reduces their liquidity.
And analysts quoted our sources seem pretty clear on this.
Yeah, one says, elevated Japanese yields spell trouble for global markets in general as they translate to increased borrowing costs. If Japan stops being the source of ultra-cheap capital, or if that capital starts flowing home, it just makes borrowing harder and more expensive for countries and companies worldwide that were perhaps indirectly benefiting.
Higher funding costs. What's next?
Market value losses and margin calls. When interest rates rise, the price of existing bonds falls.
Basic bond math.
Basic, but painful if you're holding a lot of bonds, especially with leverage. Those falling prices mean mark-to-market losses on your books.
And if those losses get big enough?
They can trigger margin calls. Your lenders demand more collateral, more cash right now.
And how do you get that cash?
You're often forced to sell assets, whatever you can sell quickly. This is the fire sale dynamic.
We saw this in the UK in 2022, didn't we? With their pension funds.
That was a terrifying example. A rapid spike in UK government bond yields gilts, forced pension funds using leverage to frantically sell liquid assets to meet margin calls, creating a doom loop.
And a similar risk exists if JGB yields spike suddenly.
Potentially, yes. Funds or banks using JGBs as collateral or just holding large bond portfolios that are losing value could be forced into selling other assets, maybe foreign assets, to raise cash.
Even the Bank of Japan seems worried about this.
They do. They've explicitly warned that an abrupt exit from their easy money policies could pose a systemic challenge to Japan's own financial system, which, given Japan's huge overseas investments, would inevitably spill over globally.
And there's something called VAR shocks?
VAR is value at risk. It's how institutions measure their potential losses. When markets suddenly get very volatile, like during an unwind, these VAR models spike.
Meaning they show a much higher risk of big losses.
And when that happens, risk limits get breached, lenders demand more collateral, and institutions are forced to rapidly deleverage, sell assets to get their calculated risk back down.
And what do they sell?
Often the easiest things to sell quickly in size are the most liquid global securities, things like US treasuries. So a VAR shock triggered by yen volatility can force selling in completely different markets, spreading the stress.
So rising costs, forced selling. What else?
The third channel is contagion and a crisis of confidence. Markets are all linked.
How does that work here?
Well, imagine Japanese investors or carry traders start dumping, say, US or European bonds in large quantities. That directly pushes up yields in those markets, but it also shakes confidence.
People see big players selling and get nervous themselves.
And if some funds or banks take major losses on their yen trades, that raises concerns about their solvency, which then affects their counterparties, the people they trade with. The worry spreads.
Albert Edwards from Sajin had a stark warning about this.
He did. He basically said, if confidence collapses in JGBs, which have been seen as a pillar of stability for so long, then confidence in the global market could go with it.
It's psychological too, then.
Very much so. When one part of the market seizes up, investors elsewhere often react by broadly de-risking selling assets that might seem completely unrelated, just to be safe. A flight to quality. This amplifies the initial sell-off and can turn a specific problem into a general liquidity crunch.
History has some pretty scary examples of this, doesn't it?
It really does. Think back to 1998, the collapse of the hedge fund Long-Term Capital Management, LTCM. That was initially triggered by losses in Russia and Asia.
But it got much worse because of the yen.
Significantly worse. A sudden surge in the yen forced leveraged players, including those involved in carry trades, to unwind frantically. This loss of confidence essentially froze liquidity across global markets.
And then 2008, the global financial crisis. Was the carry trade involved there too?
He was a major contributing factor, yes. As risk appetite collapsed, the yen carry trade unwound violently. The US dollar plunged nearly 30% against the yen in just a few months.
Why did that happen?
Investors were desperately, frantically repaying yen loans, as one source puts it. This rush out of carry trades added fuel to the fire, contributing to massive liquidations and market chaos across the board.
So if you compare these events, 1998, 2008, maybe even that tremor in August 2024.
You see clear patterns. The triggers often involve yen appreciation or policy shifts. The impacts involve rapid deleveraging, sharp asset price drops, and spikes in volatility. History certainly rhymes here.
Let's try to make this really concrete. Imagine you, listening right now, are a fund manager. You're running a strategy, borrow yen cheap, leverage it up, invest in, say, higher yielding US corporate bonds. Things have been okay, but then bang, the yen spikes 5% against the dollar in just a couple of days. What happens?
Well, first, that 5% yen appreciation instantly eats into, or maybe completely wipes out, the profit margin you expected from the interest rate difference. If you were making, say, 2% a year on the interest spread, a 5% adverse FX move is a disaster.
Especially with leverage.
That 5% currency loss gets multiplied by your leverage. Let's say you were leveraged 10 to 1. Suddenly you're looking at a 50% loss in your capital from that FX move alone, ignoring the interest earned.
Your broker's calling.
Definitely. Demanding more margin because your losses have blown through your collateral cushion. Your internal risk models are flashing bright red, that VAR shock we talked about. You are under immense pressure to reduce risk now.
So what's the quickest way out?
You need cash to meet those margin calls or just cut the position. The fastest way is usually to sell the assets you bought with the borrowed money, those US corporate bonds in this example.
You dump the bonds, get dollars.
Convert the dollars back into yen at the now much stronger exchange rate, locking in your loss, and use the yen to either pay back the loan or post the required collateral.
But if everyone who is doing a similar trade is forced to do the same thing at the same time,
then you get a fire sale in US corporate bonds. Everyone dumping them drives prices down, which pushes yields up. This causes losses for other holders of those bonds, potentially triggering their margin calls.
it's that vicious cycle again, a downward spiral kicking off from that initial move in the yen.
Precisely. That's how the stress transmits and amplifies.
Let's do another quick micro recap for this section. We've seen Japan is definitely changing course, moving away from decades of ultra-low rates.
And this shift, the rising cost of yen, the narrowing yield gap, is the fundamental trigger for a potential mass unwinding of these global yen carry trades.
We've detailed the specific ways this shockwave could spread, rising borrowing costs globally,
Forced selling of assets due to margin calls and risk limits, hitting bond and stock prices.
and a contagious crisis of confidence spreading through interconnected markets, much like we saw in historical crises like 1998, 2008.
This Japan trap, as the title calls it, isn't just some abstract idea. It's the very real risk that as Japan normalizes its unique monetary policy, the vast leveraged global system that grew dependent on cheap yen could face a violent and disruptive unwinding. Recent market jitters show how quickly this can flare up.
All right, let's lock this down with our flashcards for Chapter 2.
Flashcard Fact 1. The trigger. Rising Japanese interest rates and JGB yields signaled the potential end of the Japan era.
Flashcard Fact 2. Oh, the core risk. A mass, potentially disorderly unwinding of yen carry trade positions globally.
Flashcard Fact 3. O transmission spreads via higher funding costs. Forced liquidations from margin calls risk shocks and financial contagion.
And flashcard Fact 4. Historical parallels. Both the LTCM crisis, 1998, and the global financial crisis, 2008, saw disruptive yen carry trade unwinds, making things much worse.
We understand the mechanics and the potential shockwaves. Now, Chapter 3. The exposure map. Who's actually holding the bag if this unwind really gets going?
This sounds tricky. How do you even measure how big this whole thing is?
That's the first major challenge. One source just says estimating the total exposure is notoriously difficult.
Why is it so hard?
Several reasons. People use all sorts of different financial instruments. Some are straightforward loans on balance sheets. But a lot is done through derivatives, swaps, off-balance sheet stuff that's harder to track. There's also a lot of activity routed through offshore financial centers, OFCs, like the Cayman Islands, which adds layers of opacity. And honestly, analysts don't even always agree on what exactly counts as a carry trade versus, say, a long-term structural investment.
So the estimates we have are all over the place.
Pretty much. You see a huge range. Some more direct measures, looking at BIS data on JPY loans to non-banks outside Japan, or guessing hedge fund derivative positions, might suggest figures in the hundreds of billions to maybe a couple of trillion US dollars.
Like that BIS composite figure, around $764 billion before the August 2024 wobble.
But even the BIS admits that's likely a significant underestimate because it doesn't capture everything, especially the derivative side.
Then you get broader estimates.
Yeah, ING looked at overall cross-border JPY borrowing and came up with potentially $2.2 trillion in March 2024, with maybe $1 trillion originating as loans directly from Japan. But again, how much of that is actively carry trading versus hedged borrowing is unclear.
And then there are those really massive numbers sometimes thrown around.
Like that Deutsche Bank figure, sometimes mentioned by commentators like Arthur Hayes, suggesting something like $24 trillion of risk related to Japan's balance sheet. That almost certainly includes huge chunks of stable, long-term holdings by Japanese institutions, not just the dynamic, leveraged carry trade capital that could unwind quickly. It probably overstates the immediate unwind risks significantly.
So the uncertainty itself is a problem. Regulators maybe don't have a firm grip on the scale.
That's a key risk. And remember, the actual economic impact isn't just the face value of these positions. It's amplified by leverage. If even, say, $100 billion is leveraged 10 to 1, that's suddenly $1 trillion in notional value that could be subject to forced selling pressure.
And that leverage is often hidden.
The opacity, especially in derivatives and offshore structures, makes a full risk assessment exceedingly challenging for regulatory authorities, as one source notes.
Acknowledging it's hard to quantify precisely who are the types of players most exposed.
Well, right at the sharp end are the hedge funds and other leveraged traders. We've touched on this already. They are among the most vulnerable because their strategies often rely heavily on leverage to magnify what might otherwise be small returns from carry.
They were big players in betting the yen would keep falling.
Hugely. There were reports of net short yen positions hitting $15–20 billion in mid-2024. That's a big bet.
And August 2024 showed what happens when that bet goes wrong.
It really did. When the yen surged, they scrambled. Bloomberg said they sowed havoc dumping assets to cover losses and repay loans. It was described as a textbook VAR shock. They reportedly slashed their yen short exposure by around 40% in just a few weeks.
And it forced them to sell other things too.
Apparently so. One manager was quoted saying, "It's all about carry trades," implying the yen move forced deleveraging across their portfolios, even in unrelated assets. These guys, often using complex derivatives and repo funding, are frequently the first domino in an unwind chain. Regulators have also flagged concerns about hedge fund leverage in specific areas, like the U.S. Treasury market.
So hedge funds are clearly exposed. Who else?
The next big category is large institutional investors. And here, Japanese pension funds and insurance companies are absolutely critical.
Why them specifically?
Because they are giants. They manage colossal pools of money and have massive investments outside Japan. We're talking over $3 trillion in foreign assets as of early 2023. They are the biggest foreign holders of U.S. government debt, for example.
And the risk is they bring that money home.
That's the core concern. As yields on Japanese government bonds, JGBs, rise back home, investing domestically starts to look more attractive, especially relative to their long-term liabilities, which are in yen. So the incentive grows for them to sell some of those foreign assets, U.S. treasuries, European bonds, global stocks, and repatriate the funds.
Is this already happening?
The trend seems to have started. Japanese investors were reported to have sold a record amount of overseas debt back in 2022, coinciding with the initial rise in global and domestic yields. That little BOJ policy tweak in December 2022 also caused market ripples attributed to repatriation fears. The worry is a larger, more sustained rise in Japanese rates could trigger a much bigger wave of selling.
Now, sources compare this to the UK pension crisis, but suggest Japanese pensions might be less vulnerable.
Yes, there's an important distinction. Analysts like Wellington Management point out that Japanese defined benefit pension funds generally use less direct leverage and fewer complex derivatives, like the LDI strategies that blew up in the UK. So the likelihood of a UK-style forced liquidation crisis driven by margin calls is seen as moderately low for them specifically.
But they're not totally safe.
No, not at all. They still face risks. If JGB yields rise sharply, the value of their enormous domestic and foreign bond holdings falls. While they might not face immediate margin calls like leveraged funds, significant valuation losses could still compel them to sell assets, perhaps their most liquid foreign assets, to rebalance portfolios or shore up their overall financial health.
And given their size.
Given their size, even a relatively small portfolio shift matters hugely. Japan's main pension fund, GPIF, and major insurers have roughly half their assets overseas. If they decide to bring back even a fraction of that, it represents hundreds of billions of dollars potentially draining out of global markets. And of course, non-Japanese institutions holding GGBs also face losses if yields spike.
Hedge funds, Japanese institutions. What about banks?
Banks are central to this too, both Japanese banks and global ones.
How are Japanese banks exposed?
They hold enormous quantities of JGBs on their balance sheets, so rising JGB yields mean potentially huge unrealized losses for them. We saw this fear reflected in the August 2024 turmoil when Japanese bank stocks plunged 10–20%.
Are regulators worried?
The board is clearly watching closely. Officials have said they stand ready to act if the JGB market were to descend into a panic sell-off mode, which suggests they see bank stability as a potential issue.
And Japanese banks also lend yen globally.
Yes, they're key suppliers of yen funding worldwide. If they face pressure at home from JGB losses or rising funding costs, they might pull back on that international lending. That could squeeze credit availability globally. It echoes, in a way, the 1997 Asian crisis when struggling Japanese banks cut lending to the region, worsening the situation there.
What about global banks, those outside Japan?
They're exposed more indirectly, but in several ways. They might have their own smaller yen carry trade or arbitrage positions that get hit. They definitely have counterparty risk. If their hedge fund clients blow up on yen trades, the banks could face losses. That's a parallel to LTCM in 1998. They also hold global bond portfolios that suffer when yields rise everywhere, partly pushed up by Japan. We saw how rising rates stressed some U.S. regional banks in early 2023. So banks are connected through their own trading, their lending, their client relationships, and the overall impact of interest rates. Japanese banks are at the epicenter, but the ripples spread through the global banking system.
So that's who is exposed. Now, where did all that cheap yen actually go? What assets and regions are most vulnerable?
Fixed income bonds is a huge destination. Japanese investors buying foreign bonds over the years was a major factor holding down yields globally. If they stop buying, or worse, start selling, it's a big deal for bond markets everywhere.
The U.S. market being a prime example.
As we said, Japan is the largest foreign holder of U.S. treasuries, over $1 trillion worth. They also hold lots of U.S. corporate bonds and mortgage-backed securities, MBS.
And they've already started selling some.
Yes. Record overseas bond sales in 2022 included treasuries. Analysts point out that even a small rise in JGB yields can make holding treasuries less attractive for Japanese investors, potentially leading them to sell treasuries to buy JGBs, pushing U.S. yields higher. Rising global yields, partly driven by Japan, also make financing the U.S. deficit more challenging.
What about Europe?
Similar story, though maybe on a smaller scale than the U.S. Japanese institutions have been significant buyers of European government bonds, French, UK gilts, and also things like infrastructure debt. If that flow reverses, European yields could rise, and liquidity, especially in smaller markets, could dry up. France and the Netherlands are often cited as countries where Japanese holdings have been historically large relative to market size. European policymakers are definitely watching this quietly. Remember the UK gilt crisis to show how sensitive markets are when a major buyer steps back?
And emerging markets, you mentioned them earlier as potentially hardest hit.
Yes. EM fixed income is often seen as particularly vulnerable. These markets tend to be less liquid and more reliant on foreign capital inflows. Japanese investors, both retail and institutional, have chased higher yields there, buying EM bonds directly or through funds.
Where specifically?
Latin America, like Brazil, Mexico, and parts of Asia and Africa, Indonesia, South Africa, Turkey, are often mentioned as recipients, sometimes via specific structures like Iridashi bonds sold in Japan.
So if Japanese investors pull back,
EM bond prices could fall sharply, yields could spike, and countries with weaker fiscal positions could face real funding stress. It's not just Japanese selling either. If U.S. Treasury yields rise due to repatriation, that puts pressure on EM bonds too, as U.S. yields are the global benchmark.
Yeah.
It's potentially a double whammy, reminiscent of the 2013 taper tantrum. Reo caters. Analysts also flag smaller markets where Japanese ownership is high relative to GDP, like Australia or parts of Asia, as being at risk of outsized moves.
what about corporate debt globally?
That's exposed too. If Japanese banks and funds reduce their buying of overseas corporate bonds, leveraged loans, and other credit products, it means less demand. That tends to widen credit spreads the extra yield companies have to pay compared to governments making borrowing more expensive and increasing default risks, which then feed back into the financial system.
So summing up the bond market impact, a potential global correction, liquidity drying up, fire sale risks, especially hitting EM Japan as a potential trigger.
Pretty much. It could be the catalyst for the next big bond market shock or VAR event.
Bonds are huge. What about currency markets? They react instantly.
Instantly. They're the first signal and often amplify the stress. As Japanese rates rise, the general expectation is for the yen to strengthen. Why? Higher yield attract capital, and carry traders have to buy back yen to close their shorts.
We saw the yen hit multi-decade lows, like over 150 per dollar, but then it reversed sharply in mid-2024.
Amid BOJ policy speculation and maybe some intervention, it snapped back from around 162 towards 153 against the dollar pretty quickly. Sources said it took on a life of its own, upending the carry trades that were betting on continued weakness,
And that kind of sharp appreciation forces losses on the carry traders.
triggering those margin calls we discussed. And it typically coincides with the other currencies involved in the carry trade falling.
Like the Aussie dollar, the Mexican peso.
During that 2024 yen spike, those high-yielding currencies dropped significantly against the yen. Other traditional funding currencies, like the Swiss franc, often strengthen alongside the yen in these scenarios.
And EM currencies.
They tend to weaken significantly. The Brazilian real, South African rand, Turkish lira often fall as carry trades unwind. Interestingly, even the offshore Chinese yuan saw a sharp move against the dollar in late July 2024, suggesting maybe some yuan-funded carry trades were also being unwound.
So the overall pattern in a big unwind might be.
Typically, you'd see the US dollar weaken against the core funding currencies like the yen and Swiss franc, but strengthen against the higher-yielding EM and commodity currencies as those trades reverse.
That sounds chaotic.
It creates huge cross-currency stress. And for emerging markets already struggling with dollar debt, it's painful. Their currency weakens against the dollar, just as global borrowing costs, benchmarked off US rates, are likely rising.
Bonds, currencies. What about global equities? Stocks.
They've also been a major destination for yen-funded capital. The August 2024 unwind gave us a clue here. Japan's own 2PX stock index fell 12%. The S&P Global Broad Market Index dropped over 3%. U.S. indices declined too.
Suggesting carry trade money was significantly invested in stocks globally.
It strongly suggests that, yes. So a large-scale unwind would likely put downward pressure on global stock markets as that capital is withdrawn.
And emerging market assets more broadly, beyond just bonds and currencies.
Yes, EM equities, other securities. Research cited by sources like MRO identified currencies like the Brazilian real, Mexican peso, South African rand, Turkish lira as having negative correlations during past unwinds, suggesting they were frequent carry targets. Southeast Asian +3 countries seem to have less direct exposure, hinting the pain might be concentrated in specific EM regions.
Anywhere else this money flows. More niche areas.
Well, the search for yield is relentless. Sources mention that the August 2024 disruption even hit things like commodities and, interestingly, digital assets. Crypto markets apparently felt the impact, suggesting maybe even retail-level carry trades involving assets like Bitcoin and Ethereum were being unwound. It shows how far-reaching the tendrils of this cheap funding can be.
And you mentioned offshore financial centers earlier, like the Cayman Islands. Why are they important here?
Because they act as major conduits, especially for non-bank financial institutions, NBFIs, and hedge funds engaging in these trades. BIS data, for instance, showed massive JPY claims, over $530 billion just to the Cayman Islands in early 2024.
And the problem is the lack of transparency.
When so much activity, potentially with high leverage, is concentrated in these less transparent jurisdictions, it makes it incredibly difficult for regulators, or anyone really, to see the full picture, track the ultimate owners of the risk, and assess the potential for systemic problems. It adds another layer of danger.
Bring this home for the listener. How does this huge, complex map of exposure actually relate to you? Why should someone listening care about hedge funds in the Caymans or Japanese pension funds?
Because it's all interconnected. If you have a pension plan, chances are it invests globally. If you have money in global stock or bond mutual funds or ETFs, you're exposed. If you have specific investments in emerging markets, you're exposed.
It's not just some isolated issue for high finance.
Not at all. A major unwind of the yen carry trade wouldn't be contained to just a few players. The ripple effects through falling asset prices, rising borrowing costs, reduced liquidity could impact investment portfolios and economic conditions broadly. It demonstrates the hidden wiring of the global financial system.
All right, let's zoom back out slightly. A micro recap for this exposure map chapter.
We've established that figuring out the exact size of this exposure is really tough. Estimates vary wildly.
Partly because of hidden leverage and complex structures, especially those using offshore centers like the Caymans.
But we have identified the key types of players who are likely most exposed. Highly leveraged hedge funds, huge institutions like Japanese pensions and insurers, and the banks that sit in the middle.
And we've traced where that yen-funded capital seems to have flowed heavily into global bonds, US, Europe, EM, global stocks, certain emerging market currencies, and even into newer, less traditional assets. Creates vulnerabilities across the board.
The scale is uncertain, leverage is a key multiplier of risk, opacity is a challenge, but the potential pathways for stress to spread are pretty clear.
Nail down the flashcards for this section.
Flashcard fact 1. Most exposed. Highly leveraged hedge funds, large institutional investors, especially in Japan, and banks, both Japanese and global.
Flashcard fact 2. Key destinations. Global fixed income, especially US, EU, EM bonds, global equities, and specific EM currencies, often used as carry targets like MXN, BRL, ZAR, TRY.
Flashcard fact 3. Opacity. Significant exposure is channeled through derivative and NBFIs using offshore financial centers, like the Cayman Islands, making full risk assessment difficult.
And flashcard fact 4, hidden leverage. This magnifies potential losses and the systemic impact far beyond the visible face value of positions.
We've seen how Japan's unique decades-long experiment with ultra-low interest rates fueled this massive, almost invisible flow of capital around the globe.
Yeah, creating this incredibly complex financial structure deeply embedded in global markets, but one that's fundamentally vulnerable to changes in those very Japanese interest rates.
And we've explored how the recent cautious steps by the Bank of Japan towards normalizing its policy, combined with shifting global rate expectations elsewhere, are seriously challenging the foundations of this multi-decade strategy.
Raising the very real risk of a disruptive, potentially disorderly unwind the Japan trap.
Looking ahead, the era of exceptionally cheap, stable yen funding seems likely to be over, or at least significantly changed. The yen might still be used tactically as a funding currency, sure, but the environment looks set to be much more volatile.
Meaning it requires far more active risk management than the seemingly easy carry profits of the past.
And that poses ongoing challenges for policymakers trying to get a handle on these opaque, leveraged risks hidden within the system. And it certainly requires heightened vigilance from investors trying to navigate these interconnected global markets.
Before we go, here's a final thought to mull over, something provocative perhaps. Think about that market wobble in August 2024, the one linked to BOJ policy shifts and carry trade fears. Our sources noted it didn't just hit the obvious stuff like treasuries or the Nikkei index. It apparently also impacted seemingly unrelated areas, things like AI-related technology stocks, and even digital assets like Bitcoin and Ethereum.
What does that tell us?
Well, it highlights just how far that relentless global search for yield, turbocharged by cheap money like the yen, pushed capital. It seeped into almost every corner of the financial system, including new and innovative ones.
So the question becomes, as financial innovation keeps happening, and as global central banks continue to adjust their policies after this long era of easy money, Where might the next hidden concentrations of risk, perhaps funded by cheap money strategies like the yen carry trade, be building up?
What seemingly unrelated market could be the next unexpected casualty when one of these massive, leveraged global trades finally comes home to roost? Something to keep an eye on, definitely.
The yen carry trade made global markets look stronger than they were, fueled by borrowed money, protected by low volatility, and tethered to Japan's patience. But now, as Japanese yields rise, that patience is thinning. And when the funding dries up, the trades reverse, the assets fall, and the fire sales begin.
Please like and subscribe.